Hello students, this is the fourth video on depreciation. So far I made 3 videos. On basic concepts was the first video, and fixed installment method 2 videos with explanation and solved problems. I will share the link of those videos in the I button as well as in the description box. Please do watch those videos before watching these videos for better understanding of the concept. In this video, I will cover the diminishing balance method concept and one short solved problems I will take up so that you can understand the basic crux of the diminishing balance method. This video is helpful for all the levels of accounting students, starting from the basic level to the graduation and post-graduation level even. So we will start with the concept. Diminishing balance method. This method is also known as written down value method or reducing installment method. Under this method, depreciation is charged at the fixed rate on reducing balance of the asset every year. In the sense what? When compared to the earlier method, that is fixed installment method, the rate of depreciation will remain same and the amount of depreciation will be calculated on fixed cost. In the sense, opening value or cost of the asset, it will be calculated so that the amount of depreciation will remain same every year. That was the situation in fixed installment method. Whereas in case of diminishing balance method, what will happen here? The depreciation percentage will be calculated always on the opening value of the asset. Opening value in the sense, last year's closing value will be the opening value. On that value, we will be calculating the depreciation. Therefore, what will happen? Every year, the amount of depreciation will be different. So, this is the concept of written down or diminishing balance method, which is very important method. So, I'll explain the concept better while solving the problems. So, we'll take up the one short problem. So if you see this question, what it says, a company purchased a machinery in 1st July 2011 for rupees 60,000. The depreciation is written off at the rate of 10% under reducing installment method or diminishing balance method, one only same. Show the machinery account for 3 years, assuming that the books are closed on 31st December every year. Please bear in mind, in the earlier videos also I have explained, the 3 things are very important while doing the problems of depreciation. First is, what is the method of depreciation? Which method you are following, straight line method or diminishing balance method? And the second one is, what is the percentage of depreciation? What is the percentage of depreciation which will be charged on asset? And the last and third, which is very significant, when we are closing our books of account, what is the closing date of books of accounts? Because this date is very significant to charge the depreciation. So in this case, the date of closing of the books of account is 31st December. So we will start the problem. So machinery account we need to prepare. I have drawn the format, machinery account. When did we purchase on machinery? On 1st July 2011. So on 1st July 2011 we write to cash. How much? 60,000 we spent. So 1/7/2011 to cash. Then next date is when we are closing the books of account on 31st December 2011. We charge depreciation. So we write by depreciation account. How much depreciation we need to charge? 60,000 into 10%. But we are closing on 31st December. Till then, from the date of purchase, how many months we have used the asset? 1st July we purchased. We are closing on 31st December, in the sense we used for only 6 months. Therefore, we charge only 6 months depreciation. That comes to 3,000. How we got the 3,000? That is 60,000 into 10% into 6/12. Because we are charging depreciation for only 6 months, as we have used it for only 6 months. Clear? Then we will close the account. Both the sides we write 60,000 as it is more. And we will get the balancing figure. How much? 57,000. On which date? On 31st December 2011, this will be called as by balance carried down, that is balancing figure. This is the closing balance of the first year. And the same balance will be brought forward in the next year, that is 1/1/2012. To balance brought down. How much? 57,000. Again, we will be closing our books of account on 31st December 2012, at the end of the year. Now here we will write by depreciation. The question arises how much depreciation we need to charge. The depreciation will be calculated always on the opening value of the asset. What is the opening value? In this year the opening value is 57,000. 57,000 into 10%, that comes to 5,700 is the depreciation amount. Then we will close this account. 57,000 is higher, both the side we will be writing. Then balancing figure we are getting 51,300. So on 31st December 2012 we write by balance carried on 51,300. This will be the closing value of the what we call 2012, and opening value for 2013 will be the same, to balance brought down 51,300. Again we will charge depreciation on 31st December 2013 by depreciation. Amount will be 51,300 is the opening value on the 10%. So 51,300 into 10%, 5,130, right? Then we will close the account. We will get the balancing figure 46,170. We write it as by balance carried down. This will be the opening balance for the next year. That is 1/4/2014. To balance brought down how much? 46,170. In this way we need to solve the problem. I hope I made you understand the basic crux of the diminishing balance method. Please do watch the earlier videos even for the better understanding. So I wish you all the best. Thanks for watching the video. Do subscribe my channel, Mentor the Trusted Guide, and motivate me to make more qualitative and informative videos. Thank you very much.